The Consumer Price Index just hit 330.293 in March 2026. That is the highest reading in this entire data series, and it jumped nearly 3 full points in a single month from February's 327.460. That kind of acceleration is a consumer warning sign, and if you ignore it, your financial decisions for the rest of this year could be completely wrong. Here is everything you need to know, grounded in the actual numbers. The headline, CPI number, the one that covers all urban consumers and everything from groceries to gasoline, came in at 330.293 for March 2026. To put that in perspective, back in April 2025, that same index sat at 320.302. That is nearly 10 full index points of cumulative price pressure in less than 12 months. Prices are not cooling. They are grinding higher month after month, and the pace picked up sharply in March. Now, the Fed's preferred way of looking at inflation strips out food and energy, because those categories are volatile. That is called core CPI, technically the CPILFESL series. Core CPI for March 2026 came in at 334.165, up from 333.512 in February and 332.793 in January. Core inflation has been rising every single month in this data set, without a single pause. That matters, because the Federal Reserve is watching core more than headline, and core is not giving them the signal they need to cut rates aggressively. Speaking of the Fed, the federal funds rate has been sitting at 3.64% since January 2026. It was 3.72% in December 2025, 3.88% in November, and 4.09% in October. So the Fed has been cutting, slowly and carefully, from a peak above 4.33%, where it sat all the way from May through July of 2025. But here is the problem. With CPI at 330.293 and core CPI at 334.165, the Fed is caught in a bind. Cut too fast, and you risk reigniting the inflation they spent years fighting. Hold too long, and you risk crushing the economy with rates that are still restrictive. Right now they are parked at 3.64%, and the data is not giving them a green light to move quickly. What does this mean for housing? The 30-year fixed mortgage rate just climbed to 6.37% as of May 7, 2026. That is up from 6.30% the week before, 6.23% the week before that, and it was as low as 5.98% back on February 26. So mortgage rates have actually moved higher in recent weeks, even as the Fed has been cutting. Why? Because bond markets are pricing in sticky inflation, exactly what the CPI data is confirming. If you were waiting for mortgage rates to fall back toward 5% before buying a home, this data says that window is not open right now. At 6.37%, a $300,000 mortgage costs you roughly $1,900 a month in principal and interest alone. That is the real-world consequence of a CPI at 330.293. Now let's talk about what this means for your everyday spending. The headline, CPI, covers everything: rent, groceries, cars, medical care, clothing. When that index moves from 327.460 in February to 330.293 in March, you are feeling that at the checkout line, at the gas pump, and when your landlord sends you a lease renewal. The March jump of 2.833 index points in a single month is one of the largest single-month moves in this recent series. Compare that to the move from January to February, which was just 0.872 points, or November to December, which was 0.968 points. March is an outlier, and outliers demand attention. Here is the bottom line and what you should actually do with this information. The inflation data is telling you that prices are still rising, the Fed is not in a rush to slash rates, and mortgage rates are creeping back up even after months of Fed cuts. That combination is a consumer warning sign, the same kind of signal that drove the highest performing content on this channel. If you are carrying high interest debt, now is not the time to be passive about it. The Fed funds rate at 3.64% means your savings account, your money market, your short duration bonds are still yielding something meaningful. Use that. If you are thinking about refinancing a mortgage, the window at SUB 6% rates may already be closing, with the latest print at 6.37%. And if you are an investor watching the stock market, understand that sticky core CPI at 334.165 means the Fed's hands are tied. Fewer rate cuts means higher discount rates, and that puts pressure on growth stock valuations. The data is not ambiguous. CPI at 330.293. Core at 334.165. Fed locked at 3.64%. Mortgages back at 6.37%. Every one of those numbers is working against the consumer right now. The question is whether you are going to let that work against your portfolio too.